To the explainer. So glad you're here with us. Today, we're diving headfirst into a rapidly shifting landscape of wealth protection that is literally turning traditional finance on its head. We're going to break down some groundbreaking research on how to actually build a modern portfolio, and then we're going to zoom way out to look at a massive global shift happening in the monetary system right under our noses. If you want to understand where the world's wealth is moving and exactly why it's moving there, you're absolutely in the right place.
Okay, let's jump right in with the question that should make everyone pause for a second. Why on earth are everyday folks, people just trying to protect their retirement funds, and the world's most powerful central banks suddenly chasing the exact same assets? Historically, these two groups operate in completely different universes, but right now, their strategies are converging directly on hard assets. Today, we're taking a journey from the micro, your personal portfolio, all the way to the macro, the very foundation of global money, to figure out exactly why this is happening.
Here is our roadmap for today. We'll start with the case for alternative investments, look at the optimal portfolio mix based on decades of data, and then dig into gold's massive global comeback. After that, we'll explore the vectors of remonetization, and finally, touch on the broader picture of commodities and crypto. Let's get right to it.
Section 1. The case for alternatives. Looking at a massive 43-year study.
All right, so to kick things off, researcher Javier Estrada noticed a huge gap in the financial world. Everyday investors kept asking, hey, how much exposure should I really have to things like real estate or commodities? And nobody had a clear data-backed answer. So, to fix this, he analyzed a massive 43-year period of market data. Now, before we look at the really fun stuff, his actual findings, let's quickly clear up some jargon so we're all on the same page. Estrada wanted to focus on accessible, liquid alternatives, not exclusive hedge funds. For real estate, he used REITs. Simply put, a real estate investment trust is just a publicly traded company that manages a real estate portfolio for its shareholders, and bonus, it pays no corporate tax on its profits. It's a super easy, liquid way for anyone to get real estate exposure without, having to go out and buy an entire apartment building.
The second concept we need to quickly grab hold of is the Sharpe ratio. Estrada used this metric to optimize his model portfolios. Put simply, the Sharpe ratio measures your risk-adjusted returns. So, the higher the number, the better your returns were compared to the amount of risk you actually had to stomach to get them. This is absolutely crucial because it tells us if a portfolio is truly resilient or if it just got lucky by taking on dangerous amounts of risk.
Section 2, the optimal portfolio mix and maximizing that Sharpe ratio. So we're looking for the sweet spot, right? The portfolio that maximizes that Sharpe ratio. Well, according to Estrada's exhaustive data crunching over those 43 years, the highest possible Sharpe ratio came from a mix heavily anchored by bonds at 57% and stocks at just 23%. But here's the real kicker. The remaining 20% went straight to alternatives, 13% in gold ETFs and 7% in REITs. Think about that. A full 1/5 of the ultimate risk-adjusted portfolio belongs in alternative hard assets.
And what I absolutely love about this is that Estrada himself admits he isn't even a huge fan of alternatives. He literally said he would have been totally fine reporting that they didn't add much value, but the data spoke for itself. He found it incredibly interesting that no matter how he tweaked the criteria, whether going for maximum returns or the lowest possible volatility, alternatives, and gold in particular, just consistently showed up in a really sizable way. In fact, that ideal gold allocation was stubbornly persistent, hovering right between 10 and 13%.
So what are these alternatives actually doing for you? Well, the data shows a really cool triad of benefits. Number 1, adding gold boosts your risk-adjusted returns. Whether you take that money out of your stock allocation or your bond allocation, it is just a universal enhancer. Number 2, REITs also boost those returns, but only if you swap them for stocks. If you take from your bonds to buy REITs, it actually hurts your risk-adjusted return. And number 3, and this is the big one, alternatives basically act as a financial umbrella. They reduce risk and provide vital shelter. Estrada pointed out that a portfolio of stocks, bonds, and gold held up way better than a standard 60-40 mix during massive crashes, like the dot-com bust and the 2008 financial crisis.
Now, this brings us to a highly counterintuitive, yet brilliant point from the study. Most of us think of gold as this ultimate generational, hold-it-forever kind of asset, right? Well, Estrada found that because gold is so exceptionally good at reducing short-term volatility, it's actually more important for short-term investors than for the long-term crowd. Honestly, if you can't afford to see your portfolio take a nosedive tomorrow, gold is the exact tool you'd use to smooth out that ride today.
Section 3. Gold's global comeback, the macro shift. Okay, so we've seen how everyday investors use hard assets to protect their own nest eggs. But when we zoom out to the global stage via insights from the In Gold We Trust report, we're seeing an unbelievable parallel. On one side, you have everyday retail investors carving out that 10 to 20% defensive shelter. But on the other side, global central banks aren't just looking for a little shelter, they are executing some of the most aggressive, record-breaking strategic gold hoarding we've ever seen. While a lot of Western investors have just been trading gold to make a quick buck, sovereign nations are locking it down as a fundamental, foundational reserve asset.
And the sheer scale of what is happening, it is literally staggering. In the wake of major geopolitical earthquakes, especially the post-2008 environment and the Russian invasion of Ukraine in 2022, central bank purchases have absolutely skyrocketed. We are talking about hitting a massive all-time high in 2024. Nations are scooping up physical gold at a frantic pace that we really haven't seen since the days of the Bretton Woods system.
But here is the crazy part. They aren't just buying it. They are physically hauling it back home. The report calls this the Great Gold Repatriation. Basically, in a world that's getting more volatile and politically fractured by the day, countries want self-custody. Since 2011, over 2,000 tons of physical gold have been moved back to their home countries. Germany alone moved almost 700 tons, France moved hundreds of tons, and you've got nations like India and Hungary doing the same thing. That old era of blindly trusting your national reserves to a foreign vault? Yeah, that trust is definitely fracturing.
Section 4. Vectors of Remonetization and Gold Structural Return.
What the In Gold We Trust report makes crystal clear is that gold isn't just sitting in some dusty basement anymore. It is actively taking back its structural role in the global financial system. It's being remonetized. The report breaks this down into 6 distinct vectors. On the traditional side, gold is stepping back up as the ultimate sanction-proof reserve asset. Private institutions are rediscovering it, and central banks are literally using it as a lever to recapitalize their balance sheets. But the modern vectors, that's where it gets wild. We are seeing real discussions around gold-backed bonds, Western central banks finally waking up to become buyers, and most importantly, digitalization pulling physical gold right into the 21st century.
Let's zero in on that digital vector for a second. Take Tether, the giant stablecoin issuer. They are increasingly backing their digital tokens with actual physical gold. Between 2023 and 2025, you can see this persistent, steady climb in their gold holdings, reaching over 125 tons. This is huge because tokenizing gold solves its oldest problem, its physical bulk. Tokens mobilize gold. They let it travel at the speed of light while still giving you that rock-solid hard asset backing.
Section 5. Commodities and Crypto, Looking Beyond Gold. So gold is the anchor here for sure, but it is definitely not the only asset catching a ride on this massive macroeconomic wave. We're living in a world with higher inflation and deeper financial repression, and that's forcing a massive revaluation across the board. The report talks about this idea of performance gold. Silver, for example, has been hitting new all-time highs, even though global production has been totally flat for over a decade. Broad commodities which lagged behind stocks for years are finally breaking out to offer some serious, critical inflation protection. Interestingly, though, mining stocks are still flying way under the radar, which means they could represent a massive leverage play as the supercycle keeps rolling.
And okay, we can't talk about alternative assets without addressing the digital elephant in the room, Bitcoin. Now, the In Gold We Trust report does something really brilliant here. It doesn't pit Bitcoin and gold against each other, it unites them. It argues that modern portfolios absolutely need non-inflationary assets just to survive. Think of gold as your monetary anchor. It is pure stability. Bitcoin, on the other hand, is the digital counterpart that brings convexity and explosive growth potential. Put them together and you've got the ultimate defense against a fading fiat currency system.
To really wrap your head around why this shift into hard assets could be so explosive, just look at this number. $140 trillion. That is the size of the global bond market. For decades, bonds were everyone's favorite safe haven, but with inflation eating away at their real yields, the tides are turning fast. And here is the aha moment. The physical gold market is tiny compared to that. Literally, if even a microscopic fraction of that $140 trillion shifts out of bonds and into gold or Bitcoin, we are talking about a violent upward move in those markets.
Which brings us to the price targets. Check this out. Back in 2020, the report set a baseline target for gold to hit $4,800 by the year 2030. Well, spoiler alert, we've basically blown past that baseline trajectory. So what happens if we enter a truly inflationary scenario? Their new target is $8,900 an ounce. With entire nations hoarding it and everyday investors scrambling for shelter, the fundamental repricing of this ancient asset might have honestly just begun.
So we've seen how everyday investors are using hard assets to keep their life savings afloat. and how sovereign nations are using them as the literal bedrock of their economies. Which leaves us with one final unavoidable question to chew on. With everyday folks and the world's most powerful nations alike actively seeking shelter in hard, non-inflationary assets, what is the ultimate future of fiat currency? Thank you so much for exploring the new monetary future with me on this explainer. Keep questioning, keep learning, and I'll catch you next time.